We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gareth Soloway, President and Chief Market Strategist of InTheMoneyStocks.com and VerifiedInvestingCrypto.com. How are you today, Gareth?
I'm doing great, Tom. Thanks for having me back.
Always great to have you. And, I don't like to necessarily repeat guests too often, but, it's such a crazy time trying to keep some perspective in these markets. I think it's good to be able to have this check-in from a little more frequently here. So
I agree.
So, considering the uncertainties around the China-Taiwan situation, the conflict in Ukraine, and let's say the very hawkish last meeting from the Fed, does this time and uncertainty or time of uncertainty and dollar strength really spell weakness for the markets?
Yeah, so I think overall it's a negative, right? Anytime you have this potential geopolitical scenario, especially after Russia invaded Ukraine, it just opens a possibility that it could happen with Taiwan. It definitely puts people on the back burner. Now, the key is this market has been going up and down inversely to the US dollar. And we know that the more instability, the more upside on the dollar, right? More people hide in the US dollar for safety. And so that, again, just right there is a negative for equity markets, for crypto markets, for gold. Nicely enough, we have potentially seen a major reversal in the dollar today. So we might be seeing a short-term top there, which would be positive for risk assets.
Mm-hmm. So, Gareth, when we think about the negative factors for, let's say, the NASDAQ or the S&P, you just mentioned the kind of safety of the US dollar. Do the interest rate hikes that we've seen as well really contribute to making the US dollar that much more attractive to foreign investors?
I think it does to some extent. Yeah, I do think, Tom, it does because what you're seeing is essentially the Fed is trying to lead this push, and they're talking so aggressively hawkish. Now, I believe it's a lot of talk. I'm curious once we tick into recession, how quickly they back off from this hawkish talk. But I think they're trying to talk a tough game to make sure that inflation kind of stalls out here and does come in. But I do think raising rates sucks money out of the system, right? So just like printing and lowering rates drives money into the system, it makes money free or at least cheap. The opposite is occurring. So it's a supply-demand economics problem where when you take dollars out of the system, inevitably the dollar should strengthen. And especially since we're acting more aggressively than the ECB or the Japanese central bank, it's going to strengthen the dollar against those currencies.
Mm-hmm.
Sorry, I was just going to say something. If I could just show a chart here for you guys, because I actually think that, we just talked about, I just mentioned Japan, and I actually have a chart that dictates that I think we have a short-term high on the US dollar yen chart. And I think it's really helpful to take a look at. So let's take a look at this. Take a look at this channel. So this, again, beautiful trend line from this high going back to 2022, early 2022 here, and look at the yen, what it just did today, and how it's reversing. So these are the things that as a technician, I kind of watch for. And this, by the way, this doesn't mean that the yen is all of a sudden going to be strong and just continue to rally against the dollar. But what it tells me is in the short term, the dollar may be topping out and due for a pullback. So again, if you're looking over the next couple of weeks, I would expect further dollar weakness. And then this chart should come in and pull back, maybe down to this lower level. We'll have to watch and see. But those are just some cool stuff I love looking at.
Mm-hmm. How about we look at the same chart of the euro, because obviously these are the two biggest components of the DXY, and kind of get your take on how why you think we're seeing kind of a topping of the dollar for now.
Yeah, so the euro chart is an interesting one, and again, it's a little bit on the harder side to figure out in terms of the highs. I'm looking at this relatively fresh, but this would be something that I would pay attention to. You have this angle where you were chopping along this trend line here, and it looks like we're kissing the low end of that after a very big move to the downside. You can see we had small bounces on the euro here, but for the most part, versus the dollar. The dollar's just been dominating the euro. And again, what's interesting here is this down move is coinciding with this potential bounce in the euro against the dollar is potentially coinciding with natural gas prices starting to fall. This is another really interesting thing. We know that Russia shut off that pipeline to Europe. Everyone was panicking over the weekend. And then what you saw is natural gas started to fall even in spite of that news. And one of the things I look at, and we can go to the natural gas chart here, one of the things I follow very closely as a trader is that when you have bullish news and an asset falls, or if you have bearish news and an asset rises, that does get my attention. It's telling you something as inner workings is going against the common kind of thought process. And so look at the fall in natural gas just over the last, let's say, 3 or 4 trading days. That's a big fall. And it tells me that the euro, if this pressure from Russia maybe doesn't turn out to be as crazy, as bad as everyone's talking about, maybe that's the reasoning why we're seeing natural gas fall and could be the culprit for a euro bounce against the dollar.
So in some ways, you're looking for kind of a reversion to the mean of the euro chart.
Yeah, I think so. And again, it's hard to know how much. I don't know longer term. It's very hard to predict the longer term movements, like in 5 years, 3 years from now. But in the very least, you have to look at the euro and say it's due for a technical bounce. I would just pinpoint this level. Let me show my chart. So a couple levels that I would pinpoint as resistance if the euro starts to bounce. This one would be one of them. You can see these pivot lows right through here, and then just above that. So I think you could get a bounce on the euro, but it probably would run into major resistance around 105 to 106 on the euro against the dollar.
So is that's your, let's say, your main case for kind of this current top, or this current level being a short-term top for the dollar right now?
Yeah, I think part of it is the psychology of the market. So one of the key components of a technical trader is looking at the mental state of investors who are massively investing in a market. And what we saw was kind of this culmination of fear from Friday when that news hit. We saw the stock market really sell off sharply when the pipeline was announced that it was going to be fully shut off. And over the weekend, all of that fear kind of stewed with a 3-day weekend here in the US. So it kind of created this like max pain level where you inevitably get a reversion or reversal off of this kind of level. Then you throw in these trend lines that we showed, whether it's the Japanese versus the yen versus the dollar, or the euro versus the dollar here, and you start to think, okay, this could at least be a short-term pivot point on the charts. And I think, again, just looking at the dollar chart, the Dixie, you've had so much major upside in the charts on the dollar that it's due for that kind of relief pullback. It's just been pushed too hard, too fast.
So going back to something that you kind of mentioned earlier, does the bond market believe how hawkish the comments from Jay Powell were from Jackson Hole?
No, for sure they don't. They don't. The bond market, and again, bond market is the biggest market out there, known as the smartest money. And interestingly enough, we've been seeing, and this is something I noted after Jackson Hole, the stock market freaked out, right? Everyone's like, oh my goodness, Jerome Powell's so ridiculously hawkish. And then what do? I go to the facts. I go to the charts, right? So what I did was I said, okay, well, if he's super hawkish, the most he's ever been, shouldn't the 10-year yield be making new highs? And the answer is, I went to the chart and I'm like, wait a minute, he made these comments over here and we've gone up a little bit since then, but you're not even back to the June highs of 3.5% on the 10-year. So to me, that tells me that smart money is saying, hey, Jerome Powell, the economy is going to weaken enough over the next few months where you're not going to hike as much as everyone's anticipating. And therefore, the 10-year, at least as of now, is telling us that it has not made a new high. It is calling the bluff of Jerome Powell.
So, Gareth, again, you had mentioned earlier this idea of a weakening economy and actually ticking into recession. And considering that we've seen the definition change, what do you mean when you say actually ticking into recession? Because we've seen this two concurrent quarters of negative GDP, right?
Yeah, for sure. So it's a weird time right now because you're coming off of the COVID lockdowns and stuff like that, and then obviously there was the surge and then kind of the reflex retraction there. So I think it's one of the most hard times to really figure out what is a recession, what isn't. For me, what I'm going to look at is I'm going to look at the jobs numbers. You start to see a significant uptick in unemployment. We did see a tiny uptick in unemployment last Friday, but it was mostly due to people coming back to the workforce. I think that over the next few months, you're going to see that unemployment rise to 4%, a little bit above. And then once we see the GDP numbers remain weak plus that, then it's like, okay, this is a no-brainer official recession that you could call it that at that point.
Mm-hmm. So do we see the Fed or do you see the Fed kind of backing away from further rate hikes towards the end of this year?
I do. I really do. I mean, I have it penciled in for a 50 basis point at the end of September hike. So again, for me, now there's a lot of talk and the markets are even saying it could be 75 basis points. I'm thinking the Fed is, at least I hope they're smart enough to understand that they can't, and it's very dangerous to continue aggressively hiking rates. Because again, each rate hike takes a certain amount of time to work its way through the economy, right? Mm-hmm. So if you hike 3 times in a row, 75 basis points, and then all of a sudden in 6 months, we're in a deep recession, ask yourself, how do we get out of that recession? Because every past recession, the Fed has come to the market's rescue. QE, QE1, QE2, QE2. And I mean, you just went on and on all the way through COVID with printing money and lowering rates. And so the Fed can't do that anymore with inflation as high as it is. So I really hope they're careful. I think that they're starting to see those signs of weakness creeping in like they want, the inflation numbers coming down. And I think that that would be the goal here, to start that. They can always do 50 again later in the year if they want to, but starting to just bring it down a notch would be a very confidence boosting thing for the economy and for the markets.
So is that going to be, let's say for risk assets, is that going to be basically seen as a Fed pivot? This maybe the smart money trying to get back into risk assets as the Fed eases off that tightening policy that they have?
That's what I think. I think in the near term, that's going to be kind of like a breath of a sigh of relief, if you will, where they're on their downward shift. Now they may still do another 50 at the next meeting, maybe 25, whatever it is, but they're starting to kind of come down the mountaintop, this way at that point. And I think in the near term, that is a positive for risk assets. My thinking of, and why I'm net longer term bearish, is that I do see us going into a recession, even if they start kind of coming down on the hikes less and less, we're still headed into a full-fledged recession. And again, I think once the market realizes the Fed can't bail us out of this recession, the market's going to freak out. It's going to say, okay, this could be a long, drawn out recession, making up for all the lack of recessions that we've seen over the past 10 plus years. And that could be this kind of stagflationary kind of period in the markets. And I think that's the culprit for the next big leg down that takes us down to the pre-COVID low highs from 2020 and even below.
Mm-hmm. So you think we're going below kind of that March 2020 crash that we saw, and that would be in, let's say, S&P and NASDAQ?
Yeah, so I think into year end or early 2023, your downside target on the spiders, for instance, you're looking at that pre-COVID high. So this is kind of my target. You're looking at like 338-ish or so. But I do think before all is said and done, meaning that whether it's 2023 or 2024, this market will go below there and go quite a bit lower. And I would not be surprised if we find ourselves retesting something down in this range quite a bit lower. Like you could be looking and saying, hey, markets are net down from their all-time highs, well over 50%. From the highs put in when stimulus was at its max, when the government was sending checks and when money was essentially free. So I think there's a reckoning here that's going to come to the markets. And again, as long as inflation stays above 2%, ask yourself, how does the economy get itself out of recession once it gets in? And what if it gets bad? And that's going to be a real kicker, right? If we get into a bad recession, unemployment starts spiking to 5, 6, 7%, but inflation is still 4%, let's say. What ends up happening then? How do we handle it as an economy? And I think that's going to be all out panic in the markets when that happens.
Mm-hmm. Well, Gareth, it seems like the NASDAQ was one of the, let's say, the main beneficiaries from all of this stimulus. So do you think we have a lot further to fall in the NASDAQ than the S&P, relatively?
I do. I think, for instance, Apple, Apple short term may be due for a bounce, but overall, that stock trading at a mid-20s PE ratio. I mean, in the olden days, and we're talking 10 years ago, 15, 20. I mean, if you go back pre-stimulus and pre-quantitative easing, a company like Apple was trading at a 10 valuation. And I do think that if you get in a scenario where money isn't free anymore and the Fed's not printing, we could see a reversion to that mean of valuations, which potentially, I mean, if you see Apple go down to sub $100 stock, think about where the NASDAQ 100 is at that point.
Mm-hmm. So, Gareth, I want to stay on this this kind of risk asset theme for a little bit here. We've seen some posturing from central banks, namely, let's say South Korea, for example, that it is pledging preemptive action to stabilize markets. So what does that mean for their monetary policy and risk assets near term there?
Yeah, so definitely something I paid attention to, because I think it's like that first showcase that governments are going to be very aware of economic hardships. And so, everyone says that the Fed can't print. And I've even said that to you, that it's going to be tough for the Fed to print when inflation is still elevated. But I do think that there is a point. I mean, there will be a tipping of the scale where if things get bad enough, even if inflation's at 4%, the Federal Reserve will start to print again. I mean, imagine inflation's at 4%, but unemployment's at 15%, right? You can't tell me that the Fed's not going to try to stimulate, that the government and the politicians that are trying to get reelected are not going to try to stimulate. They will absolutely. So there's this point where things will get so bad, they will start to print again. And that's where gold becomes key. I mean, so many of these metals and inflationary things, like even Bitcoin at a certain point, becomes a no-brainer. And I think South Korea was just kind of that shot across the bow. It wasn't any major intervention. It just shows the willingness for governments to step in when things get rough.
Mm-hmm. So at that point, is that basically a stagflationary environment that the politicians are going to want to print their way out of?
Yeah, I think so. Stagflation for sure, where inflation still remains elevated, but you have that no growth or actually negative growth in the global economy. And I do think that that's exactly what they're going to want to do. And again, they have that motivation because they need to be reelected. The Fed supposedly isn't biased in that way, but I think we can look at history and show that they're still influenced. They're still humans. When people are struggling, they get that pressure on them to do things to stimulate as well.
Mm-hmm. So Gareth, considering we're beginning of September here, how do you see the metals reacting for the rest of the year? They've held up relatively well, compared to a lot of other asset classes, namely gold has held up quite well. But do you see this tide kind of turning for gold itself towards the end of the year?
I do.
And maybe because of that, let's not call it a Fed pivot, but the pivot from peak hawkishness, let's say.
Yeah, and I think the number one thing, so gold has actually been an amazing performer this year. Now, if you're trading it in US dollars, it's down a little bit on the year, but then compare it to like an S&P that's down 20% or close to 20, or the NASDAQ that's down more than that, and you really see the standout of it. But if you looked at the gold chart in terms of euros or yen, it is pretty much one of the only things that is net positive for the year. And again, the reason in dollars is the dollar has rallied 15, 17, 18% this year alone. And then gold actually is only down, I think, about 4% on the year, something like that. So again, think about that. Think about how the dollar being up 15%. In my world, I would say, if someone told me that, I'd be like, gold should be down at least 15%. It's up 15, then the dollar's up 15, gold should be down. And the fact that it's only down what it is very, very bullish. And if you get a weakness in the dollar, if we are seeing a Fed pivot here, where let's say in September they go to 50 basis points instead of 75, watch out, because that dollar will start to fall and the gold chart should take off. And let's not forget that the chart itself of gold is still very, very bullish. It is holding its channel. It's had its big move up from 2018 to 2020. Here it's consolidating. It's holding this low. And again, to me, it's saying that at some point, this is going to start to make that next move up. and likely break out to the upside. So I think for the most part, metals are the safest place to be. They've been performing well. Silver, you have that aspect of economic, kind of the industrial side, but I still think silver's at a great level. In fact, I got to show you this silver chart because I just love charts like this. Let me bring that up now here. But look at this silver chart. So here's your flag pattern, which is a perfect parallel line with these tops and these bottoms. And then look at this secondary trend line from here to here to here and right through, and look at what price did. So I think you might even have a bottom in silver here, a major bottom in silver. Doesn't necessarily mean it's going to rip to the upside right away, but a tradable bottom on silver with major technical support. So I'm a big fan of gold and silver here, and I continue to be.
Mm-hmm. Well, let's talk a little bit about the difference between gold and silver here. You showed us that chart, and it's basically a horizontal support line at that $1,700 level. We've seen it touch off that probably 3 times in the last couple months. So is that very strong support for the gold chart?
So on gold, the more a line hits, the weaker it can become. So you want to be aware of that. But again, let's take a look at the GOLD gold chart here. But again, as of now, it's holding. And again, you'd prefer it not to break this 1685 level in dollars, right? So I think that's one of the things that I'm watching for very closely. Can it hold that? Now, if it does, you have downside to about 1550 on the chart. But right now it's holding support. We're going to give it the benefit of the doubt. If the dollar really rips up, like let's say China did invade Taiwan, well, absolutely, you would see the dollar rip higher. Now, people would rotate into gold, which would offset some of the dip because of the strong dollar, but it might break, in the near term on that. We saw that during COVID, actually, where in the beginning of COVID, gold sold off with the equity markets because everyone was in full out panic. But for the most part, yeah, I think this is a good sideways choppy consolidation. It's bullish. Silver, interestingly enough, notice how this consolidation on gold is sideways, but the silver one is actually downsloping. If you want to understand the reasoning, like why isn't silver a sideways channel as well? The answer would be found in the industrial side. So remember, silver is going to trend a little bit lower when people are expecting a recession. And I think that's why you have this kind of slightly downsloping channel on silver versus gold's right angle.
So once we see that, or if we see that backing off of 75 basis point hikes to 50, what could we see as a reaction from the GDX or the GDXJ? Are the miners going to react a lot more dramatically than the underlying metal?
Yeah, I do think so. I think the miners have been abnormally, maybe not abnormally, but they've been punished so much more than gold itself because they get hit by inflation, right? So yes, they're mining gold, but gold's not going up at the same rate as inflation at this stage. And so what's going on is they still have to pay their workers more money due to inflation. Their materials cost more money. Their drilling equipment costs more money. So they've been obviously getting hammered. But if you see inflation continue to come down and the Fed pivots, I think that's the key there for the miners. And the miners at that point would perform really, really well. I got to show you this chart on the gold miners because a huge flashing buy triggered on this. And much like silver's chart, it's almost identical. But look at this. Here's a trend line. We just tagged it with the downsloping white one. And then look at this pivot right through here, right here. And then look at what we just hit and look at how gold miners, the GDX is bouncing. So I think, again, the miners look really good here. And if I'm right on this Fed pivot, you should see the miners do very, very good, very, very well.
Interesting. We've talked a little bit about inflation and how that affects the miners. And obviously a big, huge chunk of that is the price of diesel fuel and oil for them. So how is the price of oil reacting to the news that OPEC will cut production by 100,000 barrels here?
Yeah, so what we've seen is oil just continue to collapse. And historically, this is very normal. It's like you see kind of this reaction. Like in bull markets, anything slightly bullish will cause a mega spike. In bear markets, you can have good news like them cutting production, which should drive price up, and instead it drives price down. And I think what you have to keep in mind is that we're on the precipice of a global recession, whether it's whether it's Europe or whether it's someone else. It looks like everyone's headed towards slower economies. And again, you could cut 100,000 barrels of oil off the table, that's nothing compared to a global recession and the amount of oil being that won't be used. I mean, think about filling a bucket with one drip of water, which is the 100,000 cut. I mean, it does nothing. So I think it's more lip service. They're trying to kind of keep prices up. And I think it's also important to recognize that, like, China is still going to buy all the oil that Russia wants to sell, just at a discount. Like, this is one of the things which made me so bearish on oil when we saw the spike to 130 and 120, is because it's not like that oil was really going off the market. It was just going to get sold at a discount, and people just didn't understand that. Panic and greed kind of drove prices up. But again, the impact, and this is one of the big things I think Putin is miscalculating, is that what he's doing with Europe is going to drive Europe to become energy independent, whether it's nuclear or it's alt energy or it's their own drilling. And in 10 years, no one's going to need to buy the oil from Russia. And so short term, I know he's fighting a battle, he's fighting a war, but it's a big longer term miscalculation. And OPEC does this too. And sorry to get off on a rant, but the fact that OPEC wanted to keep prices above $100 a barrel or 120, huge miscalculation. Not only are you going to force the world into a recession where they're going to use less, but it stems so much innovation to alternate energy types. And they have to, really they should be trying to keep oil at like $70 a barrel and then just keep it kind of pegged right there. And again, it's greed. It's greed.
So Gareth, how do you foresee the, obviously oil, like we said, is a huge factor in inflation. So how do you see the inflation numbers coming in for the rest of the year? Do you think that the rate cuts or the rate hikes have been effective in combating the inflation that we've seen?
Yeah, I do think to some extent, right? So I fully expect inflation to come down. I just don't think it's going back to 2% in the next many, many years. But do I expect 4% in a year, somewhere in that vicinity? Absolutely. I mean, there's no way oil can go from $120, $130 a barrel down to 82 where it's trading now, and you don't see some coming in of inflation pressure. So I think that's the key. We've seen a lot of metals like copper's collapse from its highs, nickel's collapse from its highs. That's all come back in, which will help alleviate the inflation pressures. The one kicker of why I think inflation will remain above 2% is because you have the inflation on wages, right? And so basically companies have had to pay workers quite a bit more, whether they were paying $15 an hour, then they had to go to $25 an hour, whatever it may be. But what they can't do, McDonald's can't double the price of a burger overnight, right? So what they do is they'll raise it by 10%, like the dollar store raised their prices from $1 to $1.25, right? Now they're paying their employees double probably, but at the same time, they couldn't do that. They can't raise it from $1 to $2. So what they'll do is over the coming years, they'll slowly inch those prices up to compensate, and that'll keep inflation above 2% over the next few years.
I got you. Yeah, it's let's say it's a whole downstream effect of renaming your store the $2 store.
That's
instead
right.
of the dollar
this
store.
Doesn't sound as good.
the all of the signage that's going to have to go with that and everything, right?
I could see dollar plus.
Yeah, that would be the easiest way to go about it.
Yeah.
So speaking of dollar plus, maybe how low do you think we could see Bitcoin go? We've talked about that many times on the show. Last night we saw it break below 19,000. So, is this just this continuation of this risk off environment for Bitcoin?
Yeah. So Bitcoin really. So one of the first things to note here is that Bitcoin for the last 10 days prior to yesterday was basically trading sideways. And that was while the dollar was going up, which is very unusual. But the dollar spiking yesterday in the overnight last night, it was finally kind of the straw that broke the camel's back. And finally, it broke that 19.5 level, which is the 2017 high. So if I zoom out here, you can see that's this previous cycle high back in 2017. So once that happened, there were a bunch of stops that got run and it kind of pushed Bitcoin even lower. Today, we're seeing the dollar pull back, so it's bouncing, but it's a tough scenario for Bitcoin here. And I do think it's going to ultimately go lower. Doesn't mean if the dollar pulls back a little bit more, it won't have a small bounce. But I'm hard pressed to find a scenario where Bitcoin doesn't at least go to 12 to 13,000 before putting in a bottom. And I have a worst case scenario that's well below 10,000 on on Bitcoin. So I think it's important for Bitcoin investors to realize that this is the first bear cycle that the Fed is not printing money during, right? And so you have to take that into account when you're doing your cycle. So if previous cycles saw an 80 to 85% correction, you got to think this one would at least do 80 to 85%, which would be 12, 13,000, and it might even do more.
Yeah, it's an excellent point about the Fed not printing in that bear market.
Yeah. Isn't that amazing to think that it's the first since Bitcoin? You don't realize Bitcoin's been around for such a short period of time, but it's the first time that the Fed has not been printing during its lifespan.
Yeah, that is a crazy thought. So Gareth, something that you and I have talked about before is this emotional regulation as a trader. So how difficult is it to maintain during a bear market like this? And are there any tricks that you have to kind of help regulate that emotion and keep yourself in check?
Yeah, so bear markets notoriously are going to test your emotions because fear is such a pervasive, emotion to have. And so investors, you have to be ready for that. Now, the number one rule in a bear market is don't overinvest, meaning that the bigger the position you have in a bear market, the more emotional tug when it goes against you, right? So again, if you're investing more than you feel comfortable with, you need to be very careful about that because the market will push you to your extremes to the point where you almost throw in the towel or do throw in the towel. So my policy is, start small. You can always add if it goes a little bit lower. If it just goes straight up, then it was a great trade and you say thank you very much, but always err on the side of caution. And then you have to start controlling that emotion. Start paying attention to the psychology of the markets. Like, if you watch Twitter and you see something where everyone is so bullish on it, you need to create a situation in your mind where you start to say, wait a minute, let me step back. Too many people are bullish. Maybe I shouldn't jump in here. And again, look at Bitcoin. Look at the hype on Bitcoin. Look at the hype on oil when it went to 130 when Russia invaded and everyone was calling for $200 a barrel. The same things repeat over and over again in charts and in markets. And if you can just learn to not be influenced emotionally by them, you get put in such a great opportunity position.
Absolutely. Excellent, Gareth. Well, I appreciate the update and the bit of perspective on traders' emotions there. Of course, you're available on Twitter at Gareth Soloway and at ITEMS. Both excellent follows. Anywhere else you want to point to, Gareth?
Just check me out at InTheMoneyStocks.com or Verified Investing Crypto if you're a crypto person. And I'm on Twitter always chatting away, so I'll be there.
Excellent. Thanks so much for your time today, Gareth.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.